When we talk about a silver short squeeze and we want the shorts out of the market to have a fair physical price again, that is a just request. But we have to realize that when that happens, all of the commodity markets enveloped within the gold and silver markets, which are all of them because gold and silver are the money that move commodities in the first place, when we do have a fair price on the paper markets, it's going to mean a price reset for all commodities on the planet, which is going to mean that hyperinflation has already taken place and the pyramid is gone. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report for Arcadia Economics. And this week we have all-time record physical silver premiums. The record set in September 2008 during the peak of the financial crisis of that era has been hit. We are now at 40% premiums on junk silver constitutional pre-1964 coins. The only time premiums like these ever happen are in or just before financial crises. And I'm going to give you some charts that show that the next crisis is right around the corner and we might even already have begun it. Registered silver is down to 15 million ounces, and August gold drains have matched the record of July gold drains for 2 consecutive all-time records in monthly drains from the COMEX. This is not surprising considering the incredible discounts on both gold and silver that continue. As much as the Fed wants to deny it, they are going to pivot once the next financial crisis reveals itself, which is going to be very soon. Given that we have a falling money supply on a quarterly basis and the same chart patterns that we saw in 2007 to 2008, history is rhyming. It is not repeating exactly, but we are on the precipice of the next liquidity crunch, and the Fed is going to pivot, saving the banking system and sacrificing the dollar while the ECB sacrifices the euro and Europe freezes over, literally.
This silver report is brought to you by Fortuna Silver Mines, and you can see here how since acquiring Roxgold, they've become more of a gold and silver balance play, producing about 62,000 ounces last quarter, whereas compared to Q2 2021, it was about half that. So they have doubled their gold production. While silver production is down a little bit, I think that was due to COVID and some mine disruptions, but disruption is now over, and production should be up this year.
And so let's check in with the registered silver supply, down another 2 million ounces this week. I think it was 52 million now last week, and now it's 50.5 million, something like that. But the slope down from about 153 million continues, getting even steeper now. This has been the largest registered silver drain from the COMEX ever. You'll see here data goes back to 2001. It has never been this steep and this sustained and this long. Let it continue, and as long as silver prices stay as suppressed as they are, it will. So do you have the staying power to see this supply dwindle down to record lows? It shouldn't be long now. It's draining at millions a week, and it will hit record lows soon enough. This is the all-time record silver premium. As you can see here, from records going back to 2008, this has never been hit before, except in 2008, financial crisis here in 2020. If the demand for silver was actually falling, these premiums would not be climbing. They would be around 15% where they usually are. But they climb because the problem is not in silver demand, it is in the spot price. Here are the monthly gold drains from the COMEX. You can see last month was just about the same amount as this month, perhaps a little bit more, maybe by a few thousand ounces or so, but we do have another day for the drains to continue because it is on a 2-day lag, and September 2nd will record for August 31st. But whether it's actually a record or not, it's all aesthetics. It doesn't really matter. The drains are strong, they are continuing, and they will continue as long as gold continues suppressed at these prices. Now, I wanted to get into the Nasdaq. There's something going on in the Nasdaq, which is the bubble-bellwether indicator of all bubble indicators, because this is the index that the crowd follows when there is a financial mania, which there has been since 2009. You see here, this red line, the 200-week moving average, almost never gets tested during a boom, and this boom has lasted since 2008. See here, it got tested sort of during the 2011 little correction there, but not really. It was never touched. In October 2018 and December 2018, it didn't even get touched there. March 2020, during that crash, yes, the 200-week moving average was tested successfully, and there was a huge rebound. And only last month, 2 months ago or so, we tested the 200-week moving average again. However, on our way back up, we failed the retest of the 50-week moving average, as we have broken back through that blue line every time there has been a recovery. Not this time, and now we are headed back down. If we break that 200-week moving average, it will be the first time since 2008. And now let's take a zoom in on what was happening in the Nasdaq in 2008. We have here the high of late October 2007. And from then until it broke through or tested the 200-week moving average, the Nasdaq was a 28% decline from highs. And once the 200-week moving average was tested and broke, that was the waterfall decline that woke everyone up to the fact that we were in a financial crisis. Now let's go back to just a few months ago. This is the November 2021 high, very similar to the October 2007 high. Again, we have a 27% decline from highs. Last time we had a 28% decline from highs. We have a little ways to go before we hit the 200-week moving average again. And it is sitting at around 267. It'll be about 268 by the time it hits, if it hits. And when it does, it will be the first test since March 2020. And after that, if it breaks through, the first time since 2008, and that will wake up a lot of algorithms, a lot of trading algorithms, to say that we are in a new bear market in the Nasdaq and the bubble will be over. Now, this time when the bubble ends, it will end in real estate and it will end on bank balance sheets, and they will be in serious trouble. And judging by the fact that money supply, as I went over in last week's silver report, is now absolutely negative growth, about 2.62% quarterly annualized shrinkage. That is the biggest deflation rate since 1993. Way more deflationary than what was happening in 2008. And it will not affect consumer prices. It will only affect equities prices and real estate prices and capital prices, as the price of consumer goods goes up and up and up. And that will take central banks into the vice grip of stagflation, which, as they print the next round in their pivot, will destroy all currencies, in my opinion. But let's end this off with what is going on in Europe. What is going on in Europe in the electricity markets is actually very similar phenomenon to what was happening in the nickel market back during Nickel Armageddon on March 7th of this year. Remember, that was when nickel mines went short a whole bunch of nickel, and then they got squeezed out, and the price of nickel ended up some crazy tens of thousands of euros or pounds or whatever per ton. It was an all-time record high, and the LME, the London Metal Exchange, had to reverse trades. Well, look at what is happening in the electricity markets, according to an Austrian newspaper. This is an English Google translation of an Austrian article on the electricity situation there. The company called Wien Energy, which I'm pretty sure means Vienna Energy, or the energy company that supplies Vienna, Austria, with electricity. It is caught in a short squeeze. It's not that it speculates. It does not speculate, but the fiat currency system that we are all in forces companies like this, which are government-sponsored and government-backed, to use paper derivatives to hedge their risks. Here it says, the amount of security deposits required depends on further market developments. Yesterday, Monday, August 29, 2022, Wien Energy had to pay 1.75 billion euros in security deposits for energy trading. These security deposits essentially relate to electricity sales that have already been made in the past but have not yet been processed. In other words, shorts, electricity shorts that they bought in order to hedge their price as they sold the electricity forward. Together with the city of Vienna, these guarantees could be raised yesterday, so they got the bailout. On today's trading day, which is August 30th, which is 2 days ago, Wien Energy does not need any additional guarantees. Okay, so they got through the day. Due to these extreme fluctuations in the market, several scenarios were calculated and discussed with our owner, the city of Vienna, and the federal government. In the worst case scenario, namely, if the electricity price doubles again this week, we in energy would need 5 billion in guarantees. The 10 billion refer to a worsening of the situation in the worst case. Sorry. The reason that electricity is going so high so fast in Europe is not necessarily because the Europeans are freezing their butts off quite yet. It's not actual demand that is going up. It is a short squeeze due to the structure of the electricity market, which is derivative managed. That is just one tiny pyramid within the humongous pyramid that is the fiat currency system itself. And so the gold and silver community complains a lot, and justly so, about the rigged derivative markets. But it is not only the gold and silver markets that are rigged. It is all markets that are managed by paper derivatives, including the electricity markets in Europe and all markets that are managed by paper derivatives, which is basically the entire commodities complex. When we talk about a silver short squeeze and we want the shorts out of the market to have a fair physical price again, that is a just request. But we have to realize that when that happens, all of the commodity markets enveloped within the gold and silver markets, which are all of them because gold and silver are the money that move commodities in the first place, when we do have a fair price on the paper markets, it's going to mean a price reset for all commodities on the planet, which is going to mean that hyperinflation has already taken place and the pyramid is gone. The last two commodities to go into a short squeeze are going to be silver and then gold. And when that happens, that means the dollar is de facto dead. And so we're not talking about a world where we have, let's say, $500 or $1,000 silver and everything else is basically normal. We're talking about a completely different world, a completely different monetary system where everything has changed, which is what we are itching for, which is what we want, which is what we know, which is why we stack. But still, it always pays to keep in mind what we are asking for. We are asking for a different world, one that we know is inevitable and one that we know will be a lot fairer, but one that we also know is going to cause a lot of short-term suffering in those that are not prepared monetarily, emotionally, spiritually, and physically. This is Rafi of the Endgame Investor coming at you with this week's Silver Report for Arcadia Economics, and I'll see you guys next week. In what kind of world? I guess we'll find out.